Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for March 18th, 2017. Market is in bullish normal conditions. It's overbought on an annual basis, 76 out of 100. Using weekly RSI 14, it's in the low end of neutral over a 10-day period using the 10-day NDX as our indicator. Price with respect to the 200-day moving average is green bullish at 8.32. Slope of the 50 is white bullish at 0.56. ADX is still a very strong 38.5, measuring strength of trend in SPY. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and off is 1.0. The current reading is 0.995, so we are just into risk off. We take that score and look at the last 5,000 trading days, find the average and the standard deviation that allows us to compute the risk Z. Normal readings are between 1 and -1. Current reading is at -0.15. Here you see a 90-day histogram of that indicator, and we have been dipped down here into risk off conditions, but this little uptick is slightly promising. The fact that it's lingering here, though, still makes me look at the last 45 days as one in which the market is holding its breath, waiting for volatility shocks among the professionals. That's why you see record numbers of short positions in the volatility indexes. But the market continues to grind north, and the volatility decline is still prevalent. So there we are. I'm taking it one day at a time myself. I have reduced a lot of my swing trades, and especially in the volatility area, I'm playing them intraday, looking to cash them when I have them. That's not a risk that I want to take overnight right now. In blended month rebalancing, our current holdings you can see here. Next reevaluation is due on or about 1 April. These are the current leaders based on the closing price of Friday. ETF2 is still in 100% theoretical exposure in the model and in the model portfolio. Quick look at the blended monthly rebalancing portfolios, the various components. See just about everything is on a buy position except treasuries. In the extended model, some commodities, and then the short-term sectors and energy are in negative positions. We're holding cash. ETF Max, this is looking at 1,000 ETFs. The most outperforming ones on the blended 3 and 6 month. You can see Brazil, uranium, Poland, China, a little bit of India, and really some rotation into selected commodities and international markets here, perhaps responding to the U.S. bump. The S&P 500, these are the winners in the large cap sectors. What I look for here are those that are in red and green over 1 week and 1 month, because those are either the strong momentum plays or the sharp value plays. Like CSX has been outstanding over the blended period, and even on the but on the 1 month and on the 1 week, it's starting to underperform. So that's a symbol that I would look at to see if the run was really done or whether this is a chance to buy a momentum leader on sale. Conversely, things like Netflix and Lam Research have been greens across the board and turned in very powerful 1 week and 1 month numbers. And so especially like LRCX would be one that I'd look at as an attempt for follow-through, along with Applied Materials, Adobe, Wynn Resorts. We trade Wynn anyway because it's a intraday frog winner for us anyway. So this has been a really nice 1 week and 1 month return. In the market health check, we'll just take a look at the slope of the 30. It peaked here when the market had a nice 30-day run right here, and then declined almost but not quite to the zero line as it leveled off for about 30 days, and then started to hook back up, and then you notice how they get a little bump and then a continuation, and now has started to roll over again, and this is combined with some declining volatility. You can see how the Z3 lines are pinching. The slope of the 10 is positive. The slope of the 30-period regression line are positive. Price is in the middle of the 10 and 30-day trading ranges in terms of the regression channels. The dragon and the baby dragon are holding strong support here at the edge of the river, and the river itself has been in almost undifferentiated upward move here. I really see that as the second leg, but we've had 12 days of just sideways chop here and a couple days where it gave ground. 200-day moving average, we're comfortably away from that, so I see strong support down here around 235 and 233. If those were to break, then the next target would be down here at 226, and then 222, 223, and were that to break, then 218 is in play. On the upside, I could see another 5% move. That's how big these first and second legs have been. It's been holding here steady for 12 days. It did that over here, and then gave us a nice little bump from 227 to 235. So that's $8. That's about 4%. So that we could see prices up around 245, even 250, were that to be the case. So this is a market that has trades really in either direction. So I'm looking to be, I'm not looking to initiate new swing trades. I'm looking at shorter term plays focused around the momentum leaders. They're either going to continue their momentum or they're going to start giving up some of those gains to lock in profits. In ETF2, all of the sectors are on a buy signal, so we're still at 100% invested, 0% cash in the math model. You see strength in Latin America, Asia less Japan, and emerging markets, so the rotation has occurred away from the U.S. back to the globals now. EEM has been especially strong. The S&P still holding on at 56. Really for the last week, it really should be EFA now, has just tipped into the front at 59. We'll give it one more week in that condition. Inside the U.S., it's technology, then the large and mids, and followed by the small caps. Strongest emerging markets and Latin America. Weakest U.S. small caps and U.S. mid caps. So that's the worm has really turned in the last 6 weeks. Inside the sector spiders, still strength in financials, lagging in energy, everything else above average. In the world market model, the U.S. is basically slightly above average, with the exception of small cap value. Asia and Asia less Japan all looking strong, less Philippines, Indonesia, Vietnam. Brazil, Mexico, emerging markets, Latin America, all strong. Europe has now rejoined the party. The energy weakness has been a global phenomenon. Inside the ETF top 30, looking through the ETF2 lens, Brazil, Latin America back on top, along with banks, regional banks, semis, financial spider, international hedged equity. New to the top are the ones that are in green in strength and white in consistency. So that home construction, junior gold miners, India, Spain, India. Inside the Dow 30, Goldman has dropped off its leadership position now. Boeing, Apple, and J.P. Morgan. Now, Apple, for those of you keeping score at home, has marched all the way from the bottom of the stack all the way up to the top and that's just evidence of rotating leadership. So it's good to keep an eye on those when they start making their move off the bottom. So for that, what we would look at is things that are yellow in consistency but white in strength. Now we don't see any of those right now, but in the same way, Home Depot, Visa, DuPont, and Cisco are all green on strength, white on consistency. So the strength is leading the way, consistency is following up. Things that are on the way down would be ones in which the strength column is worse than the consistency in terms of color. So yellow and white are weaker areas, like Caterpillar, Travelers, and Merck. ETF liquidity based on average daily dollar volume in the last 30 days. Just notice the the tradability of the small caps compared to tech. It's 50% more volume now in the small caps rather than tech. So you can see where the speculators are going. Shifting to the daily, handful of reasonable channelings, triple screens, and auto framers. And some auto framers here. You can see Chevron at 6.4, Caterpillar 3.7, IBM 3.6. Lots of frog numbers starting to creep up as the volatility has now declined for a considerable period of time. We're going to see some fraud candidates here pretty soon. A handful of auto framers, quite a few dojis to pick from. And again, we're starting to see some numbers increase here in the fraud quality numbers as well. Auto framer stats, Chevron, oil, commodities, Caterpillar, energy, Intel. We've been looking at those all week, all reasonable. The regression line fractal framework, these are the ones in which we compare the long-term buy and holders estimate of fair value, which is we take as the RL270, and the trader's price, what they're currently trading it at, as the RL10, and we look for the biggest difference between those two psychological positions. And then we divide that distance between them by the symbol's ATR and come up with these reward to risk ratios. So the ones in the green are the ones that are most below their own RL270. These are the deep value plays. The ones in the red are overheated, and that's how many ATRs they are above their RL270. So like Apple is almost 10 ATRs ahead of its RL270. So that's one that may be, it's certainly a relative strength leader, but it may be too late in the game. And that's why we frame that one in both directions as an example. The daily squeezes are ones that have been very volatile recently, but which have had a compression in the last day. And so if we take that as the yellow zone risk, framing a trade in either direction allows for some powerful one-day moves, and the bigger the number in the reward to risk column here, the better. And so things like Target, Amazon, gold all look to be interesting, as well as energy. 30-period regression line, that's the daily on the S&P. See the polynomial has rolled over, indicating it's losing a little bit of steam, but we can already see that here when the 10 crossed its own, or the 30 crosses its own 10-period moving average. And that's at a distance more than 1 SD from average, so that is a warning that this is a potential turning point, a potential intermediate term high. You can see how the last two times slope got that steep, there were considerable rollovers here. That's priced with respect to the 200. And then when this one rolled over, at least it just kind of stabilized and mucked around. But you can see that while this one has rolled over, it's been declining as well. So are we going to get one of those big spikes? Don't know. With Trump in charge, who knows? But the potential for a volatility shock is baked into the cake right now. The steepness of the 30 is still historically pretty strong. There's only a handful of times in the last 10 years that you've seen a better 30-day move than this, and that's why my concern is on preserving the gains we've made, especially with volatility over the last 70 days being so tightly compressed. Just run through some stats for you to review. You can stop the tape if you need it. In the z-scores of the three regression line slopes I look at, the 10, the 30, and the 90, the 90 has been well overheated, and now it too has rolled over along with the 30. And that to me suggests that it's like a sea change, that the easy money of the Trump period is over. It's going to get harder and harder as people start demanding some actual results from all the rhetoric, like tax cuts and health care, to see if there's any promise of if there's any follow-through to the promises that have been made. If there isn't momentum on that, then this stabilized period could easily come back and test the lower range of the river around 227. And that's everything I want to cover today. This is Ken Long at Tortoise Capital. Keep your risk measured and your power dry.